Good Thursday afternoon, investors and traders, all Phenom Group members. This is our weekly State of the Market, and it is the first one of the new calendar year. So welcome to 2022. This is our starting point, our jumping off point. And forgive me if I have any coughs during the course of recording our weekly video, as I'm still trying to recover from a little bit of a cold that I caught through the holidays, traveling. A lot of different people you're touching and hugging, and you get my drift. Anyways, we got a long road ahead of us here in the new year, folks, and it's already starting off with, well, a little bit of everything. We've had some good and some bad. Santa Claus rally ended positively, and usually that portends well for the month of January in the year. But again, it's just one data point, one of many that we will get through here in today's State of the Market. One of the things at the beginning of the year, of course, you got to focus on that game plan. And while the markets have been at all-time highs, the S&P 500, the NYSE at all-time highs, the Dow Jones Industrial Average was at all-time highs earlier this year. If you're not able to pull the trigger on stocks here at this time of the year, at these prices, at these valuations, it's probably because you're focused on the next 3%. When the better approach is to focus on where the next 30% move in the market is going to come from. And usually that's to the upside. It's very rare that we have a 30% downside in the market. And we just had one back in 2020. What is the likelihood that we're going to have another 30% down move here over the course of 2022? It's not impossible. And with COVID, to one degree or another still lingering, it's still a low probability. Don't focus on the next 3%, focus on the next 30%, which is usually to the upside. Again, the Santa Claus rally this year, we got 1.4% gain out of that Santa Claus rally the last 5 trading days of the December period and the first 2 trading days of the new calendar year. S&P 500 gained 1.4% with a positive Santa Claus rally. And this is, January's, and this goes all the way back to 1999. It's just showing you how, the Santa Claus rally performed. Since 1999, only down 1, 2, 3, 4, 5 times. And most of the time, if you were down Santa Claus rally, you were down here, you were down there, you were down there, you were down, you were down. The only 2 times that we had a positive Santa Claus rally since 1999 was 2019, where we were positive, but for the month of January we were down, and of course 2020. It happens. All right. Let's see here. We ended last year, as most of you know, with almost a 27% gain in the S&P 500, and we looked at it through various different time frames when it comes to when you get a 20+% return in a year, what is the next 12 months? What does the next year usually deliver? This data goes all the way back to 1879. 1879. What happens after 1 year rate of change for the S&P 500 is greater than 25%? Well, since 1879, 76% of the time, the 1 year rate of change was positive. The average return, 8%. So if we look at it just since 1950, right? Just since 1950, a greater than 25% return in 1 year. The next year return, 85% of the time, you're higher. And the return is a little bit better at 11.6% on average. The last, let's see, 1, 2, 3, 4, 5, 6, 7 times, the last 7 times that we've had a greater than 25% return in the S&P 500, the S&P 500 was positive the next year as well. So we're on a 7-year win streak for 25+% gains, delivering a 1 year return in positive territory. Good stuff. All right, early December, right? We have this breath thrust. Don't forget about this. I know price action has sucked the last couple of days, and the Nasdaq was down 3.3% yesterday. S&P 500 down more than 1%. We're down like 2.5% from the recent all-time highs in the S&P 500. Like, I get it. But don't forget what just happened in December with this breath thrust here. In early December, the S&P 500 gained 3.8% in 1 week. The number of S&P 500 members above their 10-day moving average increased from 5 to 89% in only 5 sessions, the quickest reversal since October of 2020. Every time the signal triggered over the past 93 years, the S&P 500 has delivered positive returns over almost every time frame. And what a breath thrust like this shows you is that they just keep buying dips. They keep buying dips. Keep in mind, folks, we have a big new cohort of investors that came with the pandemic period, right? That the retail trader, is a lot bigger than what it was in the dot-com period. And they haven't experienced a bust like the dot-com folks that basically left. This is a retail cohort, that is used to buying the dip and being rewarded, and so they keep doing that. And it almost keeps forcing the institutional investor to join them in that exercise. So while the market is down, we don't want to forget our disciplines. Going through this choppy phase, the Fed, right? We got the FOMC minutes out from the December meeting just yesterday, and the market did not appreciate what it saw within those Fed minutes. And what it saw was the possibility. Now, keep in mind, the Fed minutes are just from the discussions that the Fed presidents are having during their 2-day meeting. There's 2 days, folks. They're going to discuss a lot. Nothing in the Fed minutes are cemented actions. They're discussions, they're game plans. It's on a wide variety of topics. But it seems like what the market took its cue from was that many of the Fed officials believe that it would be appropriate to hike rates sooner rather than later, even as early as March, which the market, I think, is coming to grips with anyways. But on top of that, there was discussion about possibly letting the Fed's balance sheet run off, meaning sell assets. And then you have full-scale tightening, right? You've got them selling assets, selling treasuries, selling tips. At the same time, they're hiking rates. And so the market goes through this, it wants to price that in. That's all. It wants to price it in. Did anything that was released in the Fed minutes yesterday change the earnings trend? No. Did it change the economic outlook? No. In fact, nothing has happened yet. Again, this is all discussion. Fed fund futures are baking in a 25-point rate hike basis point rate hike come March. Look, the economy can handle that. And then some. And the market, the Fed is smart. These are the smartest guys in the room, folks. Okay, they are. And for all the, punches that they have to take from the public, day after day and week after week, year after year, what do we do when we're in trouble, right? We call on the Fed. The Fed has got the market and economies back. The Fed doesn't have enough tools to fight off the next. How many times have we heard that over the last 12 years and since the first QE? And yet, called to the rescue during the pandemic period, and they came through with flying colors. Like, the Fed's just a punching bag. You're going to hear negative commentary left, right, front, and center. But the reality is they know what they're doing. They're the smartest people in the room, folks. They've guided us through troubled waters in the past. They'll do so in the future. Nonetheless, the market is trying to price in. And that's got to be your takeaway as an investor. Remember, your North Star is earnings. If the Fed hikes rates, it's not going to change the earnings trend. Not one rate hike, not 2 rate hikes. It's not going to change the earnings trend. We have too many people going back to work. Did you see the ADP private sector payroll report just the other day? And we got non-farm payroll report coming out on Friday. 800,000 jobs created in the month of December, according to the ADP private sector payroll report. We see the job openings rate coming down as well. People are going back to work. We're still hovering at 60-year lows when it comes to jobless claims. So for all of this fiscal cliff, and there's not any fiscal support anymore, those government checks are being replaced by employer checks. Retail sales are still growing double digits, folks. Inflation is going to have a hard time staying at these elevated levels once we get into the base case scenario going on, lapping the year over year. Remember, a lot of the acceleration in the CPI and PPI is due to the low CPI and PPI for 2020. We anniversaried all those low numbers in 2021. Now we're going to anniversary all those high numbers in 2022. It's going to be hard for inflation not to roll over. And that could give the Fed cause to pause here and there. They're still likely going to institute that first rate hike. So as far as the balance sheet runoff, again, just discussion. And the Fed is going to remain data dependent. They're going to want to see how the economy, how the market reacts to the first rate hike between March and the next meeting, which is May. Right? There's not an April meeting. And maybe they hike again in May if the economy can take it, if it's not showing signs of withering, if you will. And then probably, the later parts of the year, maybe then they solidify a plan for letting the balance sheet run off, selling assets. But it's going to take some more time for them to actually message that. The Fed has slow walked us up to the tapering. They're slow walking us into the first rate hike. More than likely, they'll slow walk us into the balance sheet runoff. So this was just the first hint of it. We had many hints before tapering and then accelerating. So this is the first hint of the balance sheet runoff. But again, the market wants to price this in. Let it. Nothing has changed in your North Star. This is opportunity. You have got to be patient, control your emotions during these market sell-offs. Stay engaged. Execute your game plan. If you feel that your game plan should be modified, the best thing to do is not pause and sit on your hands and letting prices go down. It's simply adjusting your position size. The worst thing that you can do is, pause and wait for prices to go low, because that's a form. It's a form of market timing. It's masquerading as being patient when you're really trying to time, lower prices. You don't know that those lower prices are going to come. Again, I refer to, we haven't had deeper corrections, but we have had a larger cohort of that retail investor stopping those deeper corrections. And yes, it is them, folks. We've seen the data. Who's to say they won't do it again? Don't get me wrong. Get a bigger correction, we get a bigger correction. It's bigger opportunity. Keep your wits about you. Apple, right? Just, I think on Monday, $3 trillion, right? Before, everything starts to fall apart. And by the way, this is what happened in the past when it hit $1 trillion and $2 trillion in 2020. Human behavior repeating itself. Hits $3 trillion and we start to fall. And that's the whole of the market each time. Remember, Apple's the largest market cap instrument in the S&P 500, followed by Microsoft. Microsoft was already, going through some price consolidation. So now you have your two biggest stocks, going through consolidation after achieving these milestones, folks. But imagine if you bought that dip there and there. Right? All we're doing is talking about higher prices for Apple. These are opportunities. Don't let them pass you by, folks. All right, this chart, many of you have seen before. We've got 3 years of double-digit gains. Last time we saw that. Right here, yeah. 12, 13, 14. Before that, 5 years in a row back in the 90s, 95, 6, 7, 8, 9. But here's also the drawdowns. And after, the 2021 calculations are done, the average intra-year drawdown since 1980 is a cool 14%. So these are normal to be expected, should be baked into your game plan. We should anticipate the probability of a 14% drawdown on any given year at this point. And seeing how we haven't had a 10% correction in now 439 days, it should elevate in your game plan that probability. Because we're not going to go forever without. We're not going to go forever without a 10% correction, folks. All right, so here's something else that just happened. We had a 10% plus gain in the fourth quarter. So don't forget, that just happened. We're, in the new year now, but another 10% gain in the fourth quarter. We had a 10% gain in the fourth quarter of 2020, by the way. And how did that work out? Positive returns. There have been 56 quarters that have seen the S&P 500 index gain 9% or more since 1933. The chart above displays the cumulative growth of $1 invested in the S&P 500 for 3 months after a 10+% quarterly gain. Like, you buy strength, folks. You buy strength. Yeah, you buy weakness too. Why? Because the market goes up over time. You got to get into that mindset. Don't worry about the drawdowns. Worry about picking good stocks, being in good sectors, being in good industries. And if all of that is difficult, index ETFs, maybe even leveraged index ETFs to give yourself a little bit more alpha. That's why we trade TQQQs. It's an index ETF for the NASDAQ. It's leveraged 3 times. Yeah, your drawdowns are going to be steep because it does have a lot of leverage when the market does come down. But when it reverts to that upside, you are generating alpha. Again, there are many different ways to skin a cat here in the market, folks. Just don't make it difficult on yourself. If you're not a good stock picker, don't try to be a stock picker. If you don't know enough about cycles, business cycles, market cycles, and what sectors to be in and what sectors to avoid, don't pick sector ETFs. Okay, it looks like I lost y'all there for a second, and I'm back. Okay, so as I was saying, we all know that the market will go up over time. Don't make it complicated on yourselves. If you're not a good stock picker, don't pick stocks. If you're not a good sector picker and you don't know market cycles and what sectors to be in and what sectors to avoid, don't pick sector ETFs. Go with your index ETFs. Keep it simple, folks. Many different ways to skin a cat here in the market. All right, we had an above average return in 2021, the same as we had an above average return in 2020. And many of you have seen this study before here by Bank of America. When you have an above average annual return, you typically have an above average January return and an above average Q1 return. It didn't work out for January last year. Right now, it's not looking like it's going to work out for us this year. But we'll see. We got time. We have time. Let things play out. Again, human behavior. We got a whole quarter, and we still have a long way to go in January. Above average returns tend to breed above average returns. Momentum begets momentum. First 5 days, I forgot about that. First 5 days. Remember the January trifecta, which is the Santa Claus rally, first 5 days of January, and the January barometer. First 5 days of January, we got some work to do here, folks. Let me refresh that because we've come under pressure here over the last hour after Fed President James Bullard came out with, again, more hawkish commentary from the Fed. This is where we ended last year, 47.66. Here's where we are right now. We've got, we need 61 points basically, to have the first 5 days of January fire positively in that January trifecta, which includes Santa Claus rally, first 5 days of January, and the whole of January return. We'll see if it happens. But I didn't want to overlook that piece of quantitative data. All right, big Q4s equal big Q1s. Usually they do. Here's the data, folks. The fourth quarter gained more than 10%. Turns out 10% gains likely mean continued strength. The S&P 500 was higher 2 quarters later the past 12 times. The past 12 times we've been up in Q4 10% or more. The next 2 quarters or 6 months, the market has been positive. The next quarter, it's been up 88% of the time. The next 2 quarters, up 82% of the time. 12 months out, it's up 70% of the time. Again, lean into the probabilities. Yes, I know the Fed. I know this. You don't think the Fed has been involved in some of these years? Of course it has. Of course it has. All of the data we're looking at always has circumstances. Going back to 1950, you had inflation in the 1970s, remember? You don't think the Fed was involved in the 1970s, the 1980s, the 1990s? The Fed is always involved. The Fed is a constant, right? Well, otherwise, why do people complain? The Fed's going to tip us into a recession, into a bear market. The Fed is the only thing holding up this bull market. It's always, the Fed is always there. Yeah. All right, here's another one, the December low indicator. All right. If you don't take out the December low in the first quarter of a new year, it is usually bullish for the full year returns. Where was the December low? Let's check it out. So the December low was right there on day one, 45.13. As long as we don't take out 45.13, and think about it, folks. I mean, the Fed, right? They're gonna hike rates. We're getting a hawkish commentary about possibly a balance sheet runoff. Imagine if the market doesn't take out 45.13. I mean, we're only talking about what, 5, 6, 7% drawdown from the all-time highs down, to take that number out. With that kind of tightening probability, that speaks volumes about the risk appetite for equities. Now, of course, I'm saying that as if it's not going to happen. I don't know that it is, and I don't know that it's not. But imagine if we don't. Given that kind of rhetoric and that kind of potential tightening ahead, that screams bullish, I think. I think that screams bullishness. So 45.13 is your number, folks. And if we don't take that out, the market has been positive 94% of the time dating back to 1950. Pretty awesome probabilities. Like if there's a number you're looking for, folks, that's the number. 45.13. All right. If it does take it out, it's not the end of the world. Okay. On years going back to 1950 where it has taken it out, the average return is 3.3%. The positivity rate for the market is 58% of the time. It's almost 60% of the time it's positive. It's not the end of the world, but it does suggest you temper your expectations for the S&P 500 in 2022. Again, we have not had a 10% correction in 439 days, folks. The average is 331 during a secular bull market in between 10% corrections. Even if we do get that 10% correction here near term or at some point during the course of the year, focus on your 4 by the dip indicators. If they're flashing green, execute. execute, execute. S&P 500 drawdown since the 2008 crash, 2010, 2011, 15, 2018. That was at the beginning of the year. So we had 2 corrections, and at the end of the year. And of course, 2020. There's been plenty of corrections during the current bull market. It's not like downturns have been outlawed, folks. 6 double-digit corrections. Now, as I've said before, I'm not going to fancy small caps. I know that people are beating the drum of small caps over large caps. They did it last year. It failed. They're doing it again this year. And it may start out well this year the same way it started out last year. It doesn't mean you should go chasing that, because usually that is not what's going to work for the whole of a calendar year. Secondly, if you do go after that and it turns out poorly, your drawdowns, right? When we do have corrections in the market, small caps take it on the chin much harder than large caps. Here's the drawdowns again since the 2008 crash: 20%, 29%, 26%, 27%, and 41%. Just saying. And this is still a secular bull market, folks. It still may have 5 to 10 years to run. You can't fight this. Trying to call every major top that never materializes, or you can embrace it by looking for opportunities that arrive with periodic price consolidation. Cash on the sidelines, prices consolidate, deploy it. Don't run from sales. And I know this is new information. If the Fed tightens, they may tighten. The market dictates policy, folks. The market will tell the Fed when it's overdone or overstepping policy. The market will tell the Fed, and the Fed will listen. It always does. It did so in 2018. The market had that 19.8% correction. And what did the Fed do? Move to the sidelines, no more rate hikes. It was on pause throughout 2019 into the back half, where it actually started cutting rates. The market dictates. Don't worry about the Fed overstepping. When it does, and if it does, the market will scream at the Fed. That's usually your time to actually buy, not sell, and worry. You know, this here is from Ben Carlson of Ritz-Hold Financial Capital. And according to him, he says we've had long-term 6 market cycles over the past 100 years. There were many booms and busts within these long-term cycles. There will always be cyclical bear markets during secular bull markets, and vice versa. And these are the 6 different cycles that he believes we've had. I don't disagree. You're down, you're taking a drawdown early in the year. Again, the worst thing that you can do is hit that sell button on good stocks, on index ETF. It's the worst thing that you can do. You're down, let it play out. Extend your time horizon. As time horizons grow, equity losses actually diminish. One day. Extend your time horizon out to a year. It's a difference of 20 percentage points in terms of potential losses. Extend your time horizons, folks. All right. Volatility was there in December. What does that portend for January when we had the highest median average for the VIX in December of last year, which is highly unusual. It's actually only happened 1, 2, 3, 4, 5 times in the past. The VIX was the highest median average in the month of December last year. Usually January, you still have some growth there. Let's see. Oh, this is the S&P 500. Sorry, my bad. S&P 500, when December was the most volatile month. It's actually positive 80% of the time. It's a small sample size. as I always say, when you look at quantitative data like this, you want 6 samples. You got 1, 2, 3, 4, 5, 6. It's perfectly 6, so it's usable. We're right at the threshold. 80% of the time, the January was positive. The year, 80% of the time was positive. The average return is basically what most people think the S&P 500 is going to do this year, high single-digit returns. Interesting. All right, last week we talked about year 2 of a presidential cycle, and we know it kind of, right? Again, just reiterating. Positivity rate is only 55% going back to 1950. Does it get any better if we go back even further? Not really. 1928, positivity rate 56%, as opposed to 55% if we only go back to 1950. The year 2s just don't generally deliver, robust returns. Here's the good news, okay? Because year 3 of a presidential cycle usually does deliver, as you can see here, very good returns. So here's something that I found. July 1, starting July 1 of the second presidential year through June 30 of the first presidential year. So basically, you buy in July and going out to the next year 1 of the next presidential, so 3 years. Look at the return since 1934. NASDAQ only have data here since 1986. The average return over that 3-year period is 50.6% for the S&P 500, 61.6% for the NASDAQ. Keep that in mind, folks. So yeah, could it be turbulent here in the beginning of the year, in the first half of the year, even through, the first couple summer months? Absolutely. That's typically what we see during a midterm election year as well, right? The market generally doesn't take off until the fourth quarter of the election year. But do you want to buy when it's already taking off, or do you want to buy when we're still in the doldrums and prices are still low, if not lower? 50% return over the next 3 years. The only times we were red, 2006 to 2009, 1946 to 1949. That's it. This is a high win rate, folks. Keep that in mind. We talked about the Fed's going to hike rates, and I know you've seen this chart before. Kind of want to run through it one more time. Just, again, it's about repetition. Just, getting used to understanding the ebbs and flows around rate hike cycles and what the market may do, may not do for different sectors, right? Because all you hear about is higher rates, stay away from tech. There is literally no data, none, that validates that, none, nonetheless. All right, and this one goes back to 1964, 3 months before. The S&P 500 is up 7.2%, 3 months before the first rate hike. 3 months after, basically flat, which tells us you're getting that schism in the market. It's pricing it in. But 6 months later, it's up 6.5%. Again, since 1964, 12 months later, up 10.9%. Look at information technology, folks. It's up 3.3%. 3 months after the first rate hike, 6 months later, 12 months later. This goes back to 1964. Is that a good representation? No, technology is more a part of this market since the 90s, in the turn of the century. It's the most heavily weighted sector in the S&P 500 now, and has been for more than a decade. So let's look at, before and after the first Fed tightening since 94. And we had tightening in 94, 99, 04, and 15. All right, before, 3 months before, and here's the S&P 500, positive. After, right? So when we narrow our time frame, the S&P 500 actually took at least 3 months before it hit its low of the tightening cycle. 6 months later, it's up 3.8%. Let's look at technology here. Before, doing well. 3 months later, it's down, but it's down less than the S&P 500, which tells you folks are starting to buy here. And eventually it feeds through to the S&P 500. 6 months later, technology is up 11.2%. The only sector that has done better, real estate. Stay away from technology. Why? Buy this weakness. Buy it, buy it, buy it. No matter where we're looking, back to 1964, since 1994. Now, let's look at tapering, okay? Sector performance in 2013 into and after tapering. Internals performance or sector performance from the announcement to the start of tapering back during Bernanke, when he announced tapering in May of 2013. Through the end of that year, here's technology, up in Europe, up in the United States. Fast forward to the start of tapering, which started in January of 2014. Technology down in Europe, but it's positive in the United States. From January 14th through July 2014, technology was still positive. It wasn't the best performer, but if you had bought financials, look at that. Consumer discretionary, industrials, staples. Could this time be different? Could be. We're not giving a lot of lead time so far as tapering, right? We're in tapering, and it's possibly going to end, by March with the first rate hike coming. And here's a visual aid for you, looking at the chart. Russell 3000, or the equal weight information tech relative average. First rate hike. Look at that. Positive. Stay away from tech. Why? There's literally no data that tells us to do that. And yet you constantly hear it on CNBC every day. Maybe it becomes this self-fulfilling prophecy. Enough people hear it and they do stay away. I don't know. But earnings rule all. And whatever Apple reports and Microsoft reports, if they go down, buy the dip. They're going to come back. All right. We talked about rates moving higher. Yields are moving higher. We've had a really big move in yield since the turn of the year. But keep in mind that real yields, or Treasury inflation protected securities, TIPS, are still deeply, deeply negative, folks. Let's show you that in real time here. They're negative 0.91. They're negative 0.91 right now, folks. And it's been rising with the 10-year yield recently, as you can see here. But these are still some of the lowest levels in history for real yields. And when real yields are this low, when they're negative, returns on the S&P 500 are spectacular. Why do you think the S&P 500 has been doing as well as it has been doing since the pandemic? You can talk about, the Fed this and fiscal stimulus that till you're blue in the face, but all that we've seen are negative yields. And in negative yielding environments, folks, the TIPS tipping point seems to be at 0.5%. Anytime the yield on the 10-year TIPS, real yields, is 0.5% or greater, the stock market has delivered an annualized return of 5.1%, which is below the long-term average. When the 10-year TIPS yield is under 0.5%, the stock market has delivered an annualized return of 23.3%. And where is it, folks? It's negative. It's not just under 0.5%. Let's see. I know I think it delivered like a 38% return over 2 years when it's below negative 0.5%. And right now it's below negative 0.5%. It's down 0.91%. Rates are going to move up. The 10-year yield is going to move up, but real yields adjusted for inflation are still deeply negative. Even if this gets to 0.50% negative, that is still a good environment for risk assets. Extend your time horizons. Be willing to buy the dip as long as your 4 buy the dip indicators are still flashing green. Are earnings still growing? Yes. They're projected to grow 9, 10%, and usually the beat rate is like 75 to 80%. I wouldn't be surprised if we see earnings growth of the teens this year. Again, beating estimates. Is the yield curve inverting? No. Buy the dip. Is the economy growing? Yes. Buy the dip. Are we going into a recession? No. Buy the dip. All right, folks, until next week, you got it.